Hello, and welcome to Trading the Trend. My name is James Boyd. With me is Connie Hill in the chat. We welcome her and all of you. We got BJ with us, Willis with us, Kelly, Scott, James Doyle, WW, and many others. Marco Brecht, 610, and we welcome all of you here today. Kevin as well. Now, just real quick, this is not a one-off session. We meet each week and we ask the same question each week. What trends are you riding? Now, your spouse is asking that same question, he or she, right? What trends are you riding? How are you making your capital grow? Or how are you protecting it? Okay. So that's kind of what our focus is here today. Where are those trends, bullish or bearish? Now, today we're going to talk about things a little bit from a bearish perspective, a little bit. Going to talk, kind of walk us through a little bit of maybe 2 or 3 bearish traits. I'm not saying all bearish, but we're going to kind of talk about kind of that learning progression of learning bearish, okay? And I'm going to be talking about some areas that are still going down despite the market going up. Now, we'll talk about why an investor who is bullish would want to know that, seeing both sides of the coin, not just bullish, but also seeing what bearish investors are looking for. I think as you actually learn more about being bearish, you help yourself seeing both sides, not just the side you want to see. Now, also remember with what we discussed, we'll talk about stocks and options. Remember that options carry a high level of risk not suitable for all investors. Some options have different risk profiles, and we'll show that here today. Some have defined risk and so on, and we'll bring that up as we show examples. Now, remember that the information here is provided for general informational purposes only. We use what's called a paper money software application known as the Thinkorswim desktop. It has real trading and paper trading. And so feel free to practice the strategies that we talk about and see if it's something you would consider, okay? And also remember when we talk about examples, investing involves risk. When we also talk about probability analysis, theoretical nature, not guaranteed. It's really looking at the math of the trade, the numbers. And also when we show maybe futures or futures prices, we're not trading futures, but we might look at example like what's the price of oil or what's the price in gold and so on. That's what we're looking at. What's the price? Okay. Now we'll talk about here today, just super quick, where the indexes are. I taught the class last session, so I'm not going to dive into maybe that depth, maybe 3 minutes or so. And I want to dive into some of these examples. Now, first off, we're not going to lie. Okay. Portfolios, margin, not at a brand new high for the year. Needs a little bit more. Not a bad first quarter. Can't tell you the percentages, but not a bad first quarter. We're in the just a couple days in the second quarter. The IRA, that actually is hitting a brand new high for the year, despite the market not being at a high for the year. Might that continue? We'll find out. Now, in these portfolios that we look at, we tend to be bullish, okay? And what I want to kind of explain to you first off is kind of that learning progression. The truth is you can't learn everything at one time, okay? It'd be nice if you did. But I want to kind of just talk about if you're learning, right? The first thing that we actually got to learn is really stop adjustments, okay? Now, I actually look at this in terms of what I call reward to risk methodology. And Scott Thompson taught this yesterday, Wednesday afternoon, and he talked about the stop methodology. I talked about it quite a bit. I've done a previous class on it where he talked about it almost nonstop. This is the first thing. I mean, if we're going to learn to be defensive or protective of our capital, we got to learn about stop adjustments. We use also what's called an 8-day low, okay? A 10-day low, okay? A 20-day low. This is a visual stop loss on the chart. Like that because, first off, the reward to risk methodology is really just based on math. Second, seeing the day's lows. If the price goes at the 8-day low, 10-day low, 20-day low, and so on, what that really does in that case is it tells us if the price is below that, why is the investor still in the position? Okay? And I'll show that. Now, the other one is learning when to sell. we use the whole moving averages, okay? Whole moving averages. We use the 10 and the 20 or 10 and 30. This actually has green, red lines and shading. I'll show that in just a moment. Now, things like example given, like covered calls, okay, married puts, or I should say protected puts, okay, callers. This is really like learning to protect. I'll even also put an index hedge, index bearish hedge. That's helpful, but that's not the first thing. I mean, the first thing is stop adjustments. The second thing is learning when to sell. And then that third thing is wonder if things start to flatten out. Wonder if I'm a little concerned that prices are going to go down. Cover calls, protected puts, callers. Okay. That's if you would consider those. Those are not bearish positions though. But I would not talk about bearish positions unless I first knew those three. Okay. Now, when we talk about bearish positions or bearish strategies, we talk about short call verticals. Okay. Which is, I'm going to kind of label that as probability based, and long put verticals, which are more profitability based. Okay. Now, if we talked about, is there a bearish strategy that is more aggressive than that? Yeah, it's short synthetic. Okay. And I'm not going to get into that, but that is kind of a tool, bearish tool, that's stronger than number 4. Okay. Now, so if you kind of said, so James, what you're saying on this is a pecking order. Okay. So in other words, step 1, what I really need to learn is if I'm in bullish positions, I need to learn about stoppages. Absolutely. If you don't know about reward risk methodology, you don't know about days lows, I mean, start there, which we talk about. Second, if you said, well, I don't know when to sell. Well, do you have the whole moving averages on your chart? Can you see the green and red lines and the shading? That it's not that people can't read it. It's actually letting them internalize what's actually happening on the chart and then leading to potential action. When we talk about things like cover calls and income strategy, protected puts, a hedge, and callers, we're talking about income and hedge. This is where you start to see the difference between I'm a brand new investor to now I actually got dadgum experience. And now you're starting to realize I'm scaring myself. I actually get it now. This for some, they actually say, man, this is what I've been working towards. Okay. Now, the 4, you actually think the prices on the index and or the stock, the sector, the industry group, or whatever, they could fall. Now, the biggest thing what I want to kind of make mention is why would someone even care about bearish positions? Now, I want you to imagine that we had 12 positions in the portfolio. I don't know, we had Apple, we had Microsoft, we had Amazon, whatever it was. And all of my positions are pointed this direction. All of them. I got 12 positions and they're all pointed up. How many of you have ever had all positions, all capital, where everything, I hope it goes up, but where did it go? Well, 100% of your portfolio is pointed in the north direction. Bad part? The market went down. All of your capital is pointed in one direction. You go into the store. Does the store have one product? Nah. That one product they're selling is a strategy. But the whole store, the car lot, is not about one product or one direction. It's actually multiple directions. The car lot sells a van. They sell a truck. They sell an SUV. They sell a compact car and so on, a full size. Why? Different directions, different probabilities, right? So what we're trying to do is we're trying to make it where the whole entire dadgum portfolio is not pointed one direction. Because if it doesn't go that direction, well, I'm all one way. Does that make sense? Type in the chat if you get it. You say, James, I've been there, done that. Yeah. Now, when we talk about doing this realistically, if we did 2 to 3 bearish positions, could we still do 2 or 3 bearish positions and still be overall bullish in the portfolio? And the answer is yes. Okay. If we did 2 or 3 bears, it's not going to mean the portfolio is overall bearish. You're still bullish, but you do have some things that, hey, I'm thinking that these might fall. Okay, now let's get to work. So first thing I would actually make sure you have this and say, okay, my pecking order right here, 1, 2, 3. I got to nail the top 2 for sure. Once I get past the top 2, then go to 3. Practice 3. Once you get actually practice the 3, which we do weekly, man, 4. You're on to 4. Now here's the thing: in your lifetime, we just went through this, right? You want to say Iran, Middle East? We keep going, right? We've seen things go down. And so we want to kind of say, look, this is my capital. This is my portfolio. How do I protect my capital? All right. Now, if we go to this, let's take a quick peek of this, kind of just where the market is, and we're going to look at some bearish examples. So first off, just real quick, here we are at the Dow. Now, you tell me, now remember on this chart, we see here the whole moving averages, which we're talking about, right? Just real quick so we can kind of set the table here, okay? The shorter term moving average is the one that's closest to the current price, the 10, okay? The second one, it's the lagging one, it's the 20. If those lines are red, you have in the shorter term a bearish trend and momentum. If those lines are green, some of you might say hallelujah, because, well, you're a bullish investor. Most of us are, okay? Now, seeing the price get above 465 and change, many investors like that. Now, this also tells us the large caps are actually probably grinding to the upside, among other things. Super quick, S&P 500. What's interesting about the S&P 500 is we're kind of at a very critical juncture, because we could have said stuff like, well, I'm not going to get in until I get above that area where we broke down from. It sounds legit. But actually, if you look at this here today, and I mean, we could just pull up yesterday, a lot of people said, I'm not going to get in until I get above 1,600. The fact that we gapped up and we held the open, that probably told you something about the chances of going higher, didn't it? We've taught that, right? You gap up, what's the support? The support's the open. Did it hold the opening yesterday? Just say yes. I'll answer the hard ones for you, okay? You hold that open price, that's the first level support. You hold that open price, path of least resistance is higher. What I've also taught you is if you break inside this old channel, what's the path of least resistance? We'll answer that hard one as well. Path of least resistance at the top of the channel. Now, this is what blows people's minds. It blows their minds, okay? I can't believe it's going up considering everything that's going on. The investors are living in the past, right? It's not saying that's the way it's going to be in the future. But as people, we kind of anchor ourselves to what happened, not what's happening. This is like in a relationship. You say something you shouldn't have. Like I did last Friday with a bunch of friends. And I said, I want it, please. I'm sorry I said that. I didn't mean to have it come across. And so we had a good laugh at that. But the biggest actually thing is investors like my friend moved on. The investors are the same way, the traders are the same way. So here's what we want to do. We know the overall market is going up. Now, that's been very helpful for the paper money portfolio. The paper money portfolio appreciates that. Don't look at Intel, don't look at Amazon, among other things, okay? The big thing I want to kind of say here is, but is everything going up? Can anyone actually tell me maybe what are some areas that are still struggling? That even despite the market going back up, it's actually hitting at fresh new lows? So let's kind of practice. Now remember, this is like tennis. In tennis, you have the forehand, and then you have the backhand. Now, I've never seen anyone win a grand slam that didn't have a backhand. Now, in the world of investing, understanding bullish forehand, bearish backhand could be helpful to the overall skill set of that investor or trader. Now, examples that we're still seeing that have been under severe pressure, and I'm going to bring up a couple. I'm going to bring up a stock example given. I'm going to bring up CRM. Now, many of the stocks that have been under pressure have been in the software area, that industry group, or underneath the umbrella of technology. And when we talk about downtrends or bearish strategies, Clearly, we are looking for stocks that are making lower lows, lower highs, lower lows, lower highs, lower lows, lower highs. Predominantly, when we look on the chart, when we do get these upward moves on the short-term moving average, yeah, they're up a little bit, but man, that green, it didn't stay green for very long. Yeah, it went up for a little bit, but then those sellers came back in and we see that red line on the moving averages. Yeah, we went up for a little bit. Well, what is the little bit? Well, I'll tell you what the little bit is. The down move, that's the pull. The downward price descension. The upward movement, by the way, the pull, that's the red line. It's going down. The green is what? Starts with an F, ends with a G. What is it? Flag. But this is not a bull flag. This is bear flag. So those upward moves, they don't last very long. Then price sell off again. Runs back to the upside, flag. Sells off again, pull. Now, hence bear flag. Now, when we also come back and say, well, what type of price patterns are we probably seeing on this? Classic would be descending triangles. Now, let's do our first trade example. Now, we know that from a technical standpoint, we just talked about technicals, but there could be some underlying issues with the business. Does anybody have their Blockbuster card still? Remember you used to, on Friday night, you and your wife, husband said, man, we're going to go Blockbuster. We're going to get a VHS cassette, and you're going to go there with your BlueBerry, BlackBerry, whatever you call it, RIM cell phone. You remember that? We all had probably both of those. Where are they now? They're not here. Okay. Now, I think BlackBerry still trades, but it's a little different, a lot different price though. So my point in saying that is technology can change, which then can change the strategic standpoint of the business, which affects demand, which affects sales, which then affects earnings. And if all that's happening, the chart could be going down because the company is not evolving or changing to kind of be in that new environment. Hence, when's the last time you went to Blockbuster? The last time you used your flip phone, okay? Now, here's the deal. When we look at CRM, let's kind of show this, okay? Whenever someone tries something new, it's like we're apprehensive. The good thing about doing paper money is it's paper money, okay? Now, example number one. We want to actually do a short call vertical. I'll explain it, and I'm going to talk about long put vertical. If someone was tippy-toeing into that pool, so to say, in the kiddie pool of options and said, look, I want to actually learn how to trade bearish, thinking the price might go down, how do you do it? Well, and by the way, this is not a stock strategy. This is a defined risk strategy. And that example, what we're going to do is we're going to bring up the paper money account. We're going to, oh my gosh, don't look at Hilton. Okay. Now, if we take a look, what is Marriott doing? Okay. You can tell me. Now, if I bring up, let's say CRM, what I'm going to do in this case is I'm going to bring up this position, CRM. And what I'm now going to do is we have calls on the left. So we're on the trade tab, type in CRM. Calls on the left, puts on the right. Now, if we're doing a short call vertical, short meaning we're selling. Whatever strike that we're selling on the call side, that's where we think the stock could stay below. All right. Now, if I actually said, okay, the current stock price is at 168, the strike above us 170, 175, 180, 185, 190. Now, why does the investor pick one or the other? Well, if we look at the column heading, delta, that's really telling us what's the chances of the stock closing 1 penny above the strike of 170. What's the chances? Okay. Second, now that's telling us there's a 51% chance as of right now. 43% chance as of right now, 42, 34% chance as of right now. Those chances change over time. Now, what I'm going to do in this case is I'm going to right click on the bid. Now I'm going to tell you this is very important because when the market goes down, it's not if it's ever going to. It will eventually. And every time the market pulls back, we say the same stuff. Next time when the market pulls back, that's when I'm going to be ready. Were you? In the last month, did you practice bearish? The reason why we're practicing a little bit bearish is we want to make sure we're comfortable. Just because the market's going up, we have some bullish positions already. We showed that. The biggest thing is we want to practice. We want to understand that we don't want to try to have our whole portfolio bullish, only to see, for example, that the ceasefires is they're not going to do it now, and we don't have anything bearish. So we're going to try to put on 2-3 bearish positions just in case. Okay. Now, example given. We're going to right-click on that 450. Right-click on the 450. Sell. Now, notice when we go sell, it gives us a strategy menu. What we're going to do is we're going to go to where it says vertical. Okay? Vertical. Now, we sell vertical. What is that doing? Well, it's selling the 180. Now, if you sell the 180, what do you want? You want the stock to stay below that. Second, we're buying the 185. And you're going to see for that, this is what they call a vertical. And you're going to see in this case, the credit or the maximum gain is $140. So even if the stock went to zero, the bad part about this strategy, the most we can make is $140. Okay? The credit. The most we could lose, defined risk, is $360. Where does that come from? The difference in the spread, 180 to 185, $5 less the credit. Okay? So what is that credit or max profit? 140. That is where we're getting the 360. To do this, it's $1.30. Okay? Now, in this case, if you were to ask me a question like, is a covered call a bear strategy? Type yes or no. Is a covered call a bear strategy? It is not a bear strategy because you own the shares. A covered call is an income strategy. Okay? Covered call does not define the risk unless the stock goes to zero. I'm not sure if that's defined risk. Technically it is, but many people would say that doesn't seem like a very good defined risk if the stock has to go to zero to get to defined risk. Fair point. Okay? What we're now going to go ahead and do is we're going to just real quick before we send that, let me kind of show you the diagram. We're going to actually we're going to right click on this line down here, anywhere on this red line, we'll right click, analyze the trade. What is this going to do? It's going to bring up a diagram for us. This diagram, it's just going to show us what this strategy is. And let me kind of just get this, right click, analyze, and I'm just going to take off any of these examples I had from before. Okay. Now, this looks really complicated, but when you kind of set this up a little bit, I'll just kind of show you this. This is if we take a look at this, we're just looking at the 180, the 185. Okay. On the bottom here, this is the stock price. Okay. So if we go to the upside, to the right, the stock goes down to the left. Okay. That is where we make the most money. On that y-axis, we're going to see that this is the dollar amount. How do we make the most money? We want the stock to go down. Okay. Stock down. That is where that blue line is the highest gain. That's why it's up there. I can put a little dollar sign right there. That's where you make the most money. Okay. Now, if the stock actually goes to the right or up, that is where we actually lose the most. And you're going to see that that's over here. We're down about that $360 we already talked about. That's what this is showing. Okay. Now, if we take a look at this, if I bring this up just a smidge, if I can, you're going to also see that there, it will tell us what the delta is. The delta is negative, meaning that this is a bearish position. The theta is actually showing slightly positive. It collects potentially from time decay. This actually is showing us what the break even is at expiration right there. Okay. That's what that's showing. Now, why would someone do a short call vertical? Why? Well, because they want to give themselves a little bit of room. If the stock were to go up, they could still be below the break even. Okay? They do not do short call verticals if they want to make the most money. They do a short call vertical because they want to define risk and they want to have a greater likelihood of being right. All right, now let's show a different example. Okay, so I'm going to go ahead and send that order, confirm and send. Now, I just got to ask you a question. There's a question in the back of my mind. How many of you have been the investor who has had all your portfolio pointed in a certain direction bullish, and then the market drops, and then you're like, I don't have any bearish positions at all? I mean, imagine if we're in the army. We send all the troops a certain direction, and we never look behind us to see if anyone's coming behind us. And you say it like that, it's kind of odd that we didn't connect those dots. Okay, that's kind of what we're doing. Okay, now, if we showed this portfolio, James, in that portfolio, as I send that now, are there quite a few bullish positions? That's bullish, 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 I mean, the whole thing's bullish. Okay, now, what I want to do is, in this case, show you the second example. Let's say the investor said, look, James, I actually think that the one more example, then we'll talk about bullish, but I'm going to go back to a stock example given. One of the other ones that's been under severe pressure has really been Adobe. Now, there's certain type of software or things that we use on the computer where maybe it might just be replicated by something else, and you just don't need it, okay? Now, sometimes the company could actually say, look, we're going to change out the CEO and create a new strategy for the business to try to adapt to the new environment as technology changes. Adobe just went through that process. Hasn't helped much yet. But if we take a look at this, we see that it gapped down on the earnings, okay? There was 2 days where it actually went above that gap, tried to reverse, but here we are again, okay? Let me kind of go back to the shading for just a sec. I think the shading, I think the color of the lines is extremely helpful, and the shading is extremely helpful. Meaning that when you take a look at this, if we see that we have the red shading, that means the shorter term moving average is below the 20. What does that mean? There's more sellers than buyers at that time, okay? Now, when there's actually that green color, that's actually showing the shorter term moving average got above the 20 at that moment in time. There's a little bit more buying pressure. You don't know ahead of time. You'll never know. I will never know. How long is that line how long is that shading gonna be there? You don't know that. That's why you invest, right? That's why you consider investing. We don't know how low it's gonna go. We don't know how high it's gonna go. It's gonna go until it's gonna go or not. Now, what you're now going to see is when we see these moves, these green up points, like we said before, it just doesn't last very long, okay? The one that lasted the longest was this one going right into earnings, but we just had another period where it went up a little bit, and then we fell down through the prior low again. Well, what do we notice? Drops down in price, comes back up. What's the type of price pattern? Your classic bear flag. If you're seeing on the chart that it looks like we drop and then we rally and that rally doesn't last very long, bear flag, okay? Now, let's say the investor said, James, I have a little bit more of a bearish outlook. I actually think the price could drop more severely. I think the company is actually in a kind of dire straits, if you will, if someone thought that. And I actually think the price, I mean, we're looking at a 3-year weekly chart and we don't even see a support level. Okay. Now, if the investor thought that price could decline more, they feel more confident about it. They want to take a trade that has a higher likelihood of, higher profitability. That trade is really called a long put vertical. Okay. So on this long put vertical example, we're going to go to Adobe. Okay. The first example we did is now we'll spend about the last 10 minutes on bullish examples because there's some bullish examples too. But I really want to emphasize this point. Are you just putting your whole entire portfolio to one direction and then wondering why you get flanked? Okay. Now, remember, we got many bullish examples, but we're going to put two positions out here today that are bearish. The market or this industry group were to continue to go down. Could it maybe benefit the portfolio? Now, could our bullish positions win? Our bearish positions win? Maybe, right? On the left-hand side, calls. On the right-hand side, puts. Now, on Tuesday, we talked about selling those puts. And we talked about selling those puts as trades. Oh, what a example. Okay. Interesting topic that was. Now, if we take a look at this, if we go to puts, we know we could, just like stock, you could buy stock, you could sell stock. Well, buying puts, you could sell puts. Okay. You buy the put, you think it's going to go down. You sell the put, you think it's going to go up. Okay. Now, if we were to do this and I say, look, I'm going to right click. Now, I'm going to choose example given. Now, we know that with a higher volatility in the market, the option spreads have been wider. We know that. We've talked about that quite a bit. What I'm going to do is I'm going to try to, this one right here between the bid-ask spread, 75 cents. That's a little wide. This one right there, 40 cents. I'm going to choose the strike that really has a tighter bid-ask spread. Now, I'm going to right-click on that $14.95, buy. The menu comes back up. Now, when we buy, what we're going to do is we're going to go buy vertical. Okay? Now, what are we doing? We're buying a put on the 235. Now, I've said before, and I'll say it again. What's the number? Now, you just saw the market go down. It was you that said, I think the market's going to go down. This market's going to just keep falling until the oil price and still they keep. Well, how many puts did you buy? And the investor might say, I didn't buy anything. Well, why not? Well, the investor says, well, I had to pay for the puts. So the biggest actually thing is people just look back and say, well, geez, you could have just bought puts and made a ton of money. But you got to remember when the stocks were going down or the market was going down, the volatility goes up and so do the put prices. Well, why does that matter? Why does it matter? Well, number one, you got to pay for it. Number two, the more you pay for the put, the more the stock has to drop to get to break even. All right, so it's not easy sometimes, right? Now, or easier. Now, if we take a look at this, let's say the investor is going to buy the 235. Well, if we bought the 235 by ourselves, just by itself, about $1,495. If we got somewhere in the middle, about $1,475. Well, what could the investor do to try to soften the blow of that to some degree? Well, number one is they could sell a put. Now, for this example, I'm going to go to the 225. Why? Why are you doing that? I'm going to try to go to the 225, widen out a little bit. I'm going to try to go to where that spread is a little bit better. It's moving on us. And we got a $10 wide spread, 235, 225. Debit there, $5. So let me ask you a question. Would you rather pay $14.95 or would you rather pay $5? $14.95 is literally $1,495. $5 is $500. What would you rather do? Now, if you did the $14.95, there's different reasons why you would do that by itself. If you said, look, I think it's going to go down, but I just don't want to have that much of a debit, like a debit card, you pay that. Well, this is going to have a built-in max loss. The debit is what you pay for it. The max loss, spread minus the debit, 500. When you do a long put vertical, you really have more of a 1-to-1 reward risk ratio. Now, when you compare the reward relative to the risk on a short call vertical, it didn't have a reward risk ratio like this. It actually looked less attractive. Hence, it was probability based. Now, if you take a look at this, it's more 1-to-1. Okay. Now, this is the biggest thing is we're going to right click on this, analyze that trade. And when you pull this up, we've seen this before. Why does this chart go to the left? Easy answer. The reason why this chart, that blue line is the highest when the stock goes to the left-hand side is because you want it to go down. Now, one time someone asked me a question without knowing what I do professionally, okay, work-wise. They said, this is back in 07, 08, what sick person would want the market to fall? I didn't say anything, okay? I just sat there and listened. I said, well, there's just some people that take different directional biases. Some people are actually evaluating the companies and they actually think the company might be in trouble. And other investors that can read the fundamentals and the price chart, they're forecasting what that stock might do. Others might say these companies are executing more fundamentally, strategically, and investors are rewarding them by pushing up the price. Okay. When I said that, he goes, it makes sense, but he goes, I don't do that. What we're trying to actually expand is he had never had any education, right? The biggest actually thing is we're trying to put the capital to where the trends are. Now, if we think actually this trend is going to go down, we're trying to put on a bearish trade, hence a bearish delta. Now, you're going to see in this case, there's the theta right there. This is what we call the option Greeks, which measures the sensitivity to direction, time, and volatility. Last trade here before we look at a bullish example or two. If I go confirm and send, second trade example that I think most investors might consider and practice alongside us. Here we are, okay, doing a long put vertical. Now, the class coming up at the top of the hour is on short verticals, Brett Crowther. So if you said, hey, I've been interested in learning about short verticals, which are credit spreads, join Brett, okay? But knowing the strategy of the vertical is critical. It's the first step in truly learning bearish, okay? Now, what we're going to do here, note the commission, going to send the order. Now, are there any questions with that? Yeah, James L says bearish trades, they're like vultures. I don't know. I'm not going to call anyone a name of them, but the biggest thing is they're just identifying what is going on, and they're just saying, hey, the company could be in trouble, and they're just saying, look, trend's down, the fundamentals are down, the company's losing market share. I mean, it's just there's winners and losers. Okay, this is not the YMCA where everyone participates and everyone gets a trophy. This is capitalism. Some win, some lose. Okay, I know. You want every people want everyone to win. In the stock market, that's not what happens. Okay, now the comment is, hey, you go 30 days to days expiration on the put. The biggest thing is yes on that example, because we're not trying to go out 60 to 90 days, right? When you talk about short call vertical, trying to go 20 to 50 days expiration to get the time decay. On that long put vertical, maybe about 30 to 50 days, because we're trying to do a short-term trade, okay? Okay, oh man. Okay, the feedback's gonna be great on the YMCA comment. You know, it really is true. I mean, we just act like, you know, all these companies are gonna win. They're in competition against each other. We realize that, right? Okay, they're not all friends. They want to beat each other. And that plays out in terms of revenue and earnings per share, stock movement, things like that. Okay, now that's the reality. So much for being friends, right? Now, here's the deal. If we come back to some other examples, okay, I want to kind of look at any other questions. Okay, answered that. Now, let's kind of talk about in the last couple minutes, what are some stocks that are I want to pull up just a couple charts. Russell, okay, now remember, now just think about in the last couple of years, we've talked about markets, okay? If we saw small caps shooting to the upside, is the market bearish? It's probably pretty inconsistent. I mean, small caps going to the upside, you think the market's kind of shorter term bullish. If you actually took at the SOX, which I mentioned last session, you're going to get a brand new closing high in the semiconductors, okay? Stocks like the Micron, okay, classic signs of reversal. We talked about this yesterday, trying to buy that on the little dip. What's the type of candle today? Help me out here. Help a brother out. Well, that might be a hammer. Well, if that's a hammer, it's hammering off that support level. Now, just real quick, Let's say the investor said, hey, maybe Micron, which is in the semiconductors, wonder if the semiconductors go to the upside and drag with it Micron. Well, crying out loud, let's show the opposite of this. And this is where it's fun. You see both sides. Okay. If we look at this, now, by the way, this is like in marriage. Okay. Here I am, the man, my wife, the woman, right? I got to see my side, state my side, but I also have to see her side and vice versa. At least that's the goal, right? Traders, investors, same way. Now, we talk about bearish, but what if you're saying, James, what I'm seeing on the chart is not red lines or the red shading. Wonder if they're green. Well, remember, like a sailor, the sailor is actually saying, which way is the wind blowing? I want to set the sail, the strategy, to where they think the wind or the trend is going. The problem is, we as people, we kind of go to a certain level or a certain spot and we don't change. Okay? Kind of like we don't move. Get stuck. Now, if we actually say, well, this doesn't look bearish, it looks bullish, we're going to adjust the sail. We're going to adjust the strategy. And what we're going to do is, instead of doing a long put vertical, the opposite of that is a short put vertical. So let's do a bullish trade. Now, if we think the stock is going to stay up above a certain level, the investor might say, well, what level do you think it might hold? Well, let's say the investor said, look, I think it could stay above 370 or 380 or 390. They might decide, hey, I'm going to try to sell one of those strikes, thinking that the price could stay not below it, but above it. Now, here's the deal. If the stock were to stay above that strike, the investor collects the premium. We're going to right-click on the bid. Vertical. Now, notice what we're doing here is we're not buying a put vertical, we're selling it. When you sell something, that's called short. Short, you sell something, you get what's also known as a credit. Now, when you sell the put at the 380, you're thinking the stock could stay above that. Okay? Now, wonder if you're wrong. Remember we talked about flanking? Well, in this case, that 370 is if you're wrong. Okay? Isn't that kind of nice to know? I think it could stay above the 380, but if I'm wrong, okay, I'm buying that 370 just in case. All right. Now, if you do that trade, if you're right, what's the most you can make? The credit, 330. Come to confirm and send. So when we talk about whether it's a short call vertical, a short put vertical, those are credit spreads. Those are probability based. Notice on this type of trade, the max profit is not as high as the max loss. Whenever that's the case, you know it's a probability type trade. Okay, the probabilities are more on your side. Notice the break even. Stock is at 413. The break even at expiration is at 376. In closing here, notice also the commission as well. So in our session here today, we did two bearish trades. We talked about kind of not having everything in the portfolio bullish, still identifying some stocks that might still be under pressure, learning that it might be useful to actually have knowledge of and education in using bearish strategies, because sometimes the market doesn't always go up. Even if the market is up, there could still be some stocks or industry groups or sectors that are under pressure. We don't want to be a tennis player that just only knows how to hit a forehand. It's probably not going to work out very well. So we want to be adaptive to different types of strategies and trends. As we do that, we become more competent and confident in our ability to ride those trends. Now, what I'm going to do is going to go ahead and send that order, and there it is right there. Now, we got Brett Crowther coming up next. Now, here's the deal. We want to make sure that if you have not subscribed to the Trader Talks channel right on YouTube, we want to actually go back to this. So right on YouTube, youtube.com, you can type in Trader Talks Schwab Coaching Webcast. I'm going to send this out. Now, the big thing is also, just real quick, is if we go back to this, Connie, let me know if there was a survey in the chat. The biggest actually thing is also is if you have not subscribed, do so. It's the simplest thing to do. It's free. Okay? Go to that link I sent you And you're going to see right in the middle of the page, subscribe. Also, for example, stay tuned for Brett Crowther coming up next. If you said, James, I'd like to learn more about probability type trading, Brett Crowther will be coming up next. Now, also remember that with what we discussed, there's a survey in the chat. Thank you ahead for filling that out. Just 2 questions. Thank you in advance. Now, also remember that with what we discussed, it was done for example, illustrative purposes, did 3 sample trades, and followed through on kind of learning and getting more educated in bearish examples. Now, also remember that all investing involves risk, and this has been the class on Trading the Trend. And stay tuned for our next class coming up next. Join me back on tomorrow at 9:30 a.m. Eastern. We'll talk about ETFs as well. Thanks so much. Take care. Bye-bye.